Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are looking at Pepsico Inc., ticker PEP. This stock has been on a run. Since its bottom in 2020, we just have been trading in this channel, and the only time it really hit resistance was around $150. It bounced off that 3 times, broke through, and really hasn't hit any resistance since. Maybe we could say somewhere around the 175 level, but it is running to all-time highs right now, and it'll probably hit some resistance once it gets around $200. That's all that there really is to look at for this chart, so let's just get right into the numbers. So here we have the numbers. Right off the bat, we got some red flags with the cost of goods has been climbing, the total expenses climbing faster than the revenue, their expense to revenue ratio, they're having those expenses creep up and cut into their margins year over year. So that's something that we're going to start watching. I saw GGG had talked about in their earnings, so I've factored it into these sheets as well. And then their gross profit has been declining because of that expense creep. Top line revenue, right in line with what we want to see, almost to the upper end of that range, coming in at 8.76% year over year. The gross profit has been growing 7.36%, net income 6.8%, EBIT 3.68%, but the net income percentage has declined off of that higher expenses. They have been able to grow earnings per share at 8.88% year over year, currently coming in at $6.79 for 2022, giving them a current PE ratio of 28.13. And for that, we see a valuation off how it's historically performed of $197.57, right in line with where it currently trades. Going forward, analysts are expecting $7.32 this year, which would bump that valuation up to $2.13, and even further out than that, the following year, $7.94 or $231. The balance sheet is in decent shape. They have been growing their assets, but their liabilities have been growing faster. They do have a negative book value, and it hasn't really moved a whole lot. So that's definitely a red flag for me. Their intangible assets are pretty significant for it to be looking like this. As for free cash flow, they've got decent free cash flow. We'd like to see it higher. It's kind of all over the place, up from 2019, but 2021 was significantly higher than 2022 came in at. Share count, they have been buying back shares, small buybacks, but it is something that we like to see. And then as for shareholders' equity, that's been growing pretty decently, 5% year over year. That means that as a shareholder, your equity in tangible and intangible assets would fetch you $12.45. So that's the balance sheet portion of what you're paying, that $190. Pretty hefty. And then the dividend, they're decent at growing their dividend, coming in 6 to 7%, currently yielding 2.4%. The market seems to like 2.6 on this stock, so we'd be looking at a value of around $176 to $77 for that dividend. For the Lynch formula, we have this stock is overvalued, a bit more than slightly overvalued. Where are these valuations coming from? The earnings is bringing in the most value. The dividend, quite a bit. I mean, the midpoint between those two would be around $180. So that'd be a 5 to 10% downside from where the stock currently sits. Free cash flow would pull that down even more, and the negative book value would, So what we'd want to see out of this stock is to continue with these strong earnings and raising that dividend. Buying back more shares would be ideal. Growing that free cash flow, working on those expenses, and getting more tangible assets and working on those liabilities. So it's not going to be a quick turnaround for this stock. I don't really believe that this run that it's on is very warranted. The reason that I've never gotten this stock in the first place is because I just thought that it was trading for way more than it needed to be. And that's what I'm seeing here. Like, if you're going strictly off earnings, sure, the price that it's trading for is fine, right in line with what it should be. But once you start to look at everything else, I might be okay with something in the range of 100 to 150. Like, if we were to adjust this to $150, we can see what the Lynch formula does. Even that brings it to still overvalued. $100 would bring it to just about fair value. And this is why I've never bought into this stock. Yeah, 75 would be great. I'd personally be looking for something closer to $75 a share, but I don't think I'm ever going to get that on this stock. I would have had to buy this back in 2010. It surpassed $75 a share in 2013 and has never looked back. Look at the earnings, though, and see what they're planning on happening this year. Maybe they are doing those improvements, and it helps bolster that valuation a little bit. Here we have the earnings. And PepsiCo is a few different brands and companies. They have Lay's, Quaker, so they do snacks as well as beverages. So it's a little bit more than Coca-Cola does. Is that diversification or diversification, as Peter Lynch likes to say? That'll stand to be told. But the stock revenues were up 10.2%. That is very good. That's above the range that we like to see, and quite a bit higher than how it's historically performed. Even with that, foreign exchange had impacted a negative 2.5%. So the earnings per share came out to $1.40, which was 54% lower than last year's earnings per share. So we'll have to look into why that is, because that is a large drop, and they will likely miss the earnings estimates that we had for this year. Looks like every region saw growth aside from Asia Pacific. We know the story there. They saw the most growth in Latin America, which is nice, for a total 10% gap change. Organic change of 14%. Convenient foods, they did see a decline. And in some locations, they saw beverage declines, but it basically netted out to nothing. For their guidance, they're expecting to return $7.7 billion to shareholders, $6.7 through dividends, $1 through share repurchases. Again, they do very low share repurchases, and they pay out a pretty large dividend. $4.60 a year is not a small amount, but when you're paying almost $200 to get that, it's 2%. They still think that their earnings per share are going to come in the same range, in fact, even higher. They moved it from $7.20 in EPS to $7.27. So we'll see if they can hit that. And now we have the numbers that we're looking for. We know that the revenues are up. Cost of sales, not up too bad. Selling general expenses. This is their issue. This is going to be what ruins them. It's up again quite a bit. Almost, that'd have to be more than 10%. And that's part of why their operating profit is cut down so much. To be fair, last year they did have this gain association with the juice transaction that really helped their profit and revenues. So even factoring that out, it's close to in line with last year. In fact, it might be a little bit better here for the operating profit. And the net income, if we subtract out 3,320, we're shy of 1,000. So revenues, so Frito-Lay saw growth, PepsiCo beverages saw growth. I'm trying to see if anything saw a decline. a little decline in Asia Pacific. And we've talked about that across a lot of companies. Last year, there was a loss in Europe. This year, it was turned into a profit. And there was a huge decline in PepsiCo Beverages North America, likely due to that juice transaction that we saw up above. Operating activities, so they were negative on cash. Now they're barely positive. And they used almost twice as much cash for operating activities as they did last year. Investing activities, they invested more. And we come down to, again, that juice transaction had helped these numbers last year. This year, they're negative. They would have been around the same last year. Slightly more negative this year, it looks like. Assets. We see a total asset growth. That is something that we like to see. Total liabilities, there is growth there too. Like the dollar amount is approximately the same between these two. So it's definitely a larger percentage growth for the liabilities than it is the assets. Let's see, shareholders' equity. There was a decline in the shareholders' equity for the company. And that really gives us the picture that we want to see. So thoughts on this? Probably going to give it a sell because it's running for no reason. I mean, we looked at the fact that 100 to 150 would be a much better price, and it's moving the wrong direction. The trends, they're seeing higher revenue growth, but their expenses are growing too, and that's their largest issue. That's what's going to be their downfall at the end of the day, is uncontrollable expenses. So until they start to cut that, I'm not interested in the stock. It's just going to keep cutting into their profit margins, and it's going to be more difficult for them to operate. They're going to be doing more to make less, and that's not what we want to see with the stock. So this is the largest holding in SCHD. I decided to do this one after looking into its holdings, and it just confirms why I don't buy ETFs like that, because I don't want this stock. I don't think that it's worth what it's trading for, and once the market figures that out, it's going to drop, and it's going to drop. I mean, if you're a true value investor, you want it to be cut in more than half. That's where the current fair value of this company is. Now, if they can continue the growth that they have, of course, that's going to climb up year over year, and it takes a while for the fair value to be met. There are some changes they can make to get there faster, and until they make those changes, I'm not interested. So I want to thank you guys for watching, and please like, comment, subscribe. Let me know what you want to see, and I'll catch you next time.